Hello, this problem is the same numbers as the problem with the discounts, except that we've got the market rate being less than the stated rate so that the bonds are issued at a premium. So this problem illustrates how this happens when you have a premium on the bond payable. Premium on a bond payable is a credit balance account. Okay, when we issue them, you can see in the journal entry here that the company received more cash for the bond than the face value. However, they're only required to pay that face value back at the end. So the bonds payable is still $600,000, but the amount of cash they received is higher than that. The difference is the premium on the bonds payable. Okay, cash paid for interest, always going to be the same amount, the face amount times the stated rate, no matter whether they're sold at a discount, a premium, or whatever. Okay, interest expense is going to be the carrying value times the market rate. Okay, so that's how we get these numbers here. And the difference, again, is going to decrease the carrying value. At the discount, they increased the carrying value. Okay? And the premium is, we're going to debit the premium, and the premium balance is going to go down each time we make an interest payment. Okay, so the first two interest payments are in the amortization schedule there, and the journal entries are shown here. Okay, let me know if you have any questions. Thank you.